Google will report earnings today after the bell, and the tech giant shares have hit a 12-month high this week. But Google's revenue is still a long way from its double-digit growth heyday. In the first quarter of this year, the company saw its first ever quarter-to-quarter drop in revenue, but then held steady throughout the second quarter. Well, joining me now is Clayton Moran. He's an analyst at Benchmark, and he's one of the few analysts who has Google as a hold, not a buy. So you're not buying the growth story here at Google just quite yet. What will it take, first of all, after the bell, for Google to surprise the markets? What is going to be considered a blowout quarter for them?
Well, expectations have been rising, and the street's now looking for net revenue of $4.2 to $4.3 billion. So it's going to, and it's been almost unanimous agreement that the quarter is going to be very positive and expectations going up. So we're going to have to beat that number, maybe 4.4, 4.5, for the stock really continue to move higher.
And what's got you a bit more skeptical than others?
We're simply not seeing any strong signs of recovery in the search advertising business. Clearly, things have stabilized, maybe improving very modestly. But really, it's going to take a more robust consumer to get search advertising moving significantly higher. I think some people don't realize the high correlation between retail sales, e-commerce, and search advertising. It's really a consumer-driven type of media, and you need more consumer strength to have confidence in search.
And yet, Clay, this, like Goldman Sachs, is a standout in its field. If you're going to avoid Google, but you want to be exposed to the tech sector, how do you play that sector?
Well, I cover specifically the online advertising sector. We like Yahoo here a little bit more than Google, surprisingly. Not so much because Yahoo is gaining share on Google or anything along those lines, but largely an expectations game. The expectations are extremely high for Google, extremely low for Yahoo, and also because Yahoo is more tied to display advertising online, which we think is seeing more concrete signs of rebound.
So you're saying,
that
Google has gotten ahead of itself and Yahoo is lagging, is what you're saying?
Exactly. That's correct.
Hey, let me jump in here. If I look at what's happened to Google earnings over the past several years, they grew 127% back in 05, then 85, then 48, then 25. This year, only 13%. Are we ever going to get back to the times when Google was growing at the kind of numbers that make, people want to pay $500 for a stock?
Well, at $500+ per share right now, it's trading at about 21 times next year's earnings. So you can't argue that it's extremely aggressive. It's probably fairly valued. But what you need to get to those over 20% per year earnings growth would be something to kick in, such as YouTube or the mobile business, some of these other businesses that have yet to really show any significant profits. And really, it doesn't look like that's happening today, probably still at least a year away.
But Clay, do you expect that when they do get back to their growth or their double-digit growth days, that will be one of the reasons why, one of those nascent businesses?
It's going to either take a V-shaped economic recovery or one of those other businesses to really kick in a meaningful way. So you really have to be, since I don't believe that one of those other businesses are going to kick in anytime soon, you really have to believe in a rapid economic recovery to be an aggressive buyer of Google here.
Okay. All right, Clay, thanks for joining us. Good to see you. Clay Moran of Benchmark on Google.